market is going to zero. Now, there's a lot of news articles out there and they're all kind of saying the same thing. And I want to take this opportunity, we cover it in our webinar, but as a separate video to give you guys a bit of an insight into what we reckon will happen looking at the GFC and the property market today. So if you look online right now, you're seeing tariffs, you're seeing everyone being freaked out over the recession. Peter Dutton saying that we're heading into a recession because of it. You're hearing from other areas that property is going to boom. Let's just take a second to break all this down. Now, there is a lot of fear in the market, but I do want to take this opportunity to look at a couple of slides that really showcases how unique Australian property is. When the world goes to shit, people look at Australian property. Now, whether or not you believe in this or not, I want to just give you guys a little bit of data around what we provide as a property market. So in Australia, you can clearly see, not so biased, Australia is 10 out of 10 in almost every single category that is really incentivizing property investment and property ownership, right? In other countries, you can argue that their economy isn't so based around supporting the property market. Now, we've got all of these things. A bank reserve system that works, a lending system that really supports property ownership, right? Homeowners, right? People that live in Australia want to actually stay here. It's a beautiful place to be. It allows us to borrow up to 80-90%, right? It allows us to release equity. All of these things that I'm listing down that Australia has, not all countries have. So when the global market starts to feel a bit of pressure from the stock markets, from their local economies, from a crime and safety, from a lifestyle standpoint, they look at Australia. It's the reason why we're basically number one when it comes to skilled migrants going into any country. So that's the first thing I want to touch upon, because when recessions hit, Australian prices and Australian property are usually in high demand. Think back to GFC, think back to COVID, and just see if that's true from your life experience. What's important also now is to look at what happened in the GFC, because it gives us a lot of insight into what will happen if we enter a recession. So if the government is true, let's see what happens for us. So back in 2007, 2008, the GFC happened. And if you're not aware, that's when the global housing and also the global stock markets really took a hit back in 2007. Now, what followed that is a lot of investor panic. People lost a crap ton of money during this time, right? They lost their super balance. They lost their stock portfolios. Heck, they might have even had to be forced to sell their property because of high unemployment rate. Whatever the reason is, the Australian government knows how to defend against global recessions. We've seen it over and over again. So what did they do? The first thing is the Reserve Bank of Australia. The first thing the RBA does when shit hits the fan is to actually reduce the cash rate. Now, what does that look like? Back in September 2008, they reduced the cash rate for the first time in 7 years, the moment they felt like the recession was coming. What that does is it allows people to borrow more. And when there's more borrowing, there's more people purchasing property. And if you know this about Australia, is that such a big portion of our global economy, all of our Australian local economy, is tied with property. The government gets incentivized when we transact in stamp duty. They get money across all boards. They get capital gains tax. Australia loves their property. Now let's take a look at what the government did in order to support the Australian economy, the Australian property market during the GFC. They announced new grants. Now, this may sound familiar because it's happening in 2025 as well. But what you guys don't know is back in October 2008, they introduced the First Home Owners Grant. Now, that grant is still available to this day, but people forget where it came from. It came from 2008. What the First Owner Grant does is give you $10,000 to purchase any property within a certain threshold, right? But back in 2008, they introduced an additional incentive, which is the First Home Owners Boost, which a lot of us forgot about, right? And the boost basically gave up to $7,000 to $15,000 for you to purchase property. And it was only temporary from October 2008 to mid-year 2009. So it was a temporary relief. What happens after that is the rates continued to drop. The RBA continued to drop their rates in order to support the property market. And then the banks also started to reducing rates. And it went from 8.0 to 5.5 in very, very quick amount of time. Now, the reason why I want to showcase this is for us not to panic. This is coming, right? The GFC market crash in 2007, right? Interest rates were at 8%. People were freaking out and properties really only dipped about 3-4%. Then in 2008 to 2009, you see how it went from 8% down to 5.5%. Now, for a lot of you guys, this was a great time to be purchasing because at the time, the median average was $470,000. And now 10 years after that, in 2018, properties were median costing $700,000. That's 50% increase, guys. And we need to understand this so we can take action today. So what can we learn from the GFC? We can learn that property is a safe haven. No matter what happens around the world, if shit hits the fan, Australian property is one of the safest asset classes in the world, right? The government, when stuff happens, the government introduces incentives in order to support our local economy. The RBA starts reducing cash rates in order to encourage property purchases. The bank then starts reducing interest rates in order to remain competitive, right? So if CBA starts dropping their rates, everyone's going to start going to CBA. It forces the other banks, ANZ, NAB, all these other institutions to follow suit and actually compete with Commonwealth Bank, just as an example, right? So that's when the banks start decreasing their rates. And what happens then is the lower the rate, the more you and I as investors, as property owners, get to borrow. And when we get to borrow, when we get to access a larger amount of property, we then go purchase property. In particular to 2008, people purchased where it was affordable, which is really important. So let's take a look at what's happening today, right? We've learned what's happened in the GFC, and I want to see if it's applicable or if we're doing the same thing. Obviously, you guys should know Trump's tariffs, right? The trade war's beginning with China, with other countries. We're getting a bit antsy with the US as well. And as a result, in Q2 2025, you can see that the stock market went down 25% overnight, right? And this will continue to be the case. It'll go up, it'll go down based on the news. But regardless, during these times where the market's uncertain, that's when the government kicks in. The government has learned from what it's done in 2008 and wants to support Australian property again, right? So the big banks are already predicting that the RBA is going to reduce rates. By how much? Up to 0.5% in May 20th. This is the exact amount of rate drop, the same thing that happened in 2008. It's happening today, guys, and it's going to happen quick. What else is the government doing? Just like the First Home Owners Grant back in 2008, now the government is introducing a First Home Mortgage Deduction scheme. Long story short, if you purchase a new property as a first home buyer, you get to get tax deductions back as if it wasn't an investment. Long story short, it allows people to purchase and hold property. And this is, again, the government trying its best to support the market. And what happens after this is we see rates continue to decrease. Currently, interest rates are around 6.5%, right? The major banks are already predicting it dropping all the way down to 3%. So again, it's happening the same sequence as it did in 2008. So what happens if rates drop to 3%? On the left-hand side here in the red, we've got scenario one where at today's market, 6.5%, if you're earning $100,000 income, you can borrow around $400,000, which is a great amount. But when rates, and if rates drop to 3%, you're borrowing an extra $250,000. You're able to now purchase property around that $700,000 mark. So what's interesting to note is the types of property that we need to invest in or we need to look at when we know rates are dropping. Because it's not about investing in all properties. There's a reason why this price bracket again and again increases. And then again, we're seeing this price bracket explode. It's because of this. What happens is, in the past, if you're already able to borrow $600,000, $700,000, you would have already purchased something $700,000, $800,000. So when rates go down to 3%, you're able to borrow an extra $250,000. Now we're noticing that when people get access to this money, they're not just purchasing any type of property. The people that are now able to borrow more, that are going into the market, are purchasing within their means. So before, if you could borrow $1 million, it never stopped you from purchasing property. You can always go and buy another $1 million property or an $800,000 property and you would have been fine. What the interest rate drops mean for people that couldn't purchase property is now that they can start buying property. And these people are in this price bracket, the price bracket between $550,000 to $650,000. So by dropping rates to 3%, It's not the people that already are rich buying more property. It's the people that have been waiting their whole lives. They're able to purchase property, and they purchase quickly because they finally have an opportunity to. So what we don't want to be doing is waiting too long before all these people that have been waiting have purchased, because that's driving the prices up, right? Overnight, people will start purchasing these affordable properties. And what do you think will happen then? When rates drop from 6.5% to 3% and you own one of these properties, you want to own it as soon as possible. You don't want to be purchasing these properties in 2026, 2027. That's when it would already be late. The government's already learnt all of these lessons, and they're trying to boost property investment. So what happens when and if interest rates hits 3%? Let's take a quick look at this scenario. On the left, you've got today's interest rates. On the right, you've got interest rates at 3%. Now, the difference is around $250,000 in borrowing capacity. What that allows people to do is allows the people that have been waiting, that have been limited, it allows them to enter the market. It's not allowing the people that already can borrow $1 million. To those guys, there's no difference, right? They can purchase from $750,000 all the way up to 1.2 mil. But it's the people that have been waiting on the sideline, that have been told their whole lives that they can't afford property. These are the guys that can really take action when interest rates decrease, okay? So that's a 250,000 increase. And what properties do these guys buy is they end up buying affordable properties. If all of a sudden my borrowing capacity went from 400,000 to 600,000, I'm able to purchase property around that $700,000 mark. And obviously I don't want to stretch myself too thin. So what we're finding is that 550,000 to 650,000 every time during recession explodes, because everyone that is able to purchases these properties. So the important thing for you guys to know is where to invest where these are the price points. And that is something we showcase in our upcoming webinar. If you guys have the opportunity now, and if you guys like what you're hearing and actually want to purchase properties within that 550 to 650,000 mark, we're doing a market update that really breaks down the different states and opportunities that are available for you, okay? If you guys click on the link below, click on the link on the screen, or if this is an ad, go ahead and click a link anywhere. It'll take you to the page on the left. What I want you guys to do is click one of these red buttons and register to one of our live sessions. And within those live sessions, you'll have the opportunity to ask any questions you want, clarify anything that you've learned today, but most importantly, understand which markets are best for you around that 600,000 price mark, and why affordable properties is the move to go with before May 20th, when the interest rates will decrease. So if you guys enjoyed this video, please like, but most importantly, register and attend our next session.